Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. All right, let's jump in. We've all seen those days, right? The market seems to have a total personality change overnight. One minute, it's a sea of red. The next is just surging with optimism. It can feel like some serious whiplash. Today, we're going to decode one of those moments, a totally wild 48-hour fire drill in the markets that perfectly shows just how fast things can change. So here's the big question. How on earth does a market plunge and then rally right back? We're going to use a sudden flare-up in US-China trade tensions as our case study today. It is the perfect example to understand the mechanics and, maybe more importantly, the psychology behind these massive swings. This is really a story of panic, politics, and some very, very powerful market indicators.
Okay, so our story begins at the end of a trading week. Picture this. It's a Friday that started with a little tension and ended in, well, total chaos. News broke that the trade dispute between the US and China was flaring up again, and it sent an absolute shockwave through global markets.
Wow. I mean, this headline really says it all, doesn't it? It just captures that raw, gut-punch fear that hit the trading floors. This wasn't just a minor dip. This was a tumble. The market's alarm bells were ringing, and they were ringing loud and clear.
And the damage was, well, it was significant, and it was widespread. The sell-off hit every major index, with the S&P 500 dropping over 2.5%. But the real story here? Look at the NASDAQ, down over 3.5%. You know, tech stocks are often a barometer for global growth, and they're super sensitive to any kind of trade friction. So that deep cut tells us just how worried investors were about the bigger economic picture.
So, we've seen what happened. Now, let's get into the why. And to do that, we really need to understand how the market felt. We're moving from the hard numbers to the emotions, because in the short term, believe me, collective psychology can be the most powerful force in the entire market. Market sentiment, it's basically the mood of the crowd. It's the vibe in the room. And when fear takes over, logic and long-term fundamentals can get thrown right out the window. Decisions are made based on gut reactions, and that is exactly what went down on that chaotic Friday. So how do we actually measure something as fuzzy as a mood? Well, one of the best tools for this is CNN's Fear and Greed Index. Think of it like a dashboard that pulls together 7 key indicators to give us a single score. It shows us whether fear or greed is in the driver's seat. And on this particular Friday, let's just say, fear had the pedal to the metal. Let's look at one of the key components here. The VIX, which people often call the market's fear gauge, absolutely skyrocketed. A rising VIX means traders are betting on bigger, wilder price swings in the near future. It's a classic signal that anxiety is taking hold and investors are scrambling to buy protection against a potential crash. So where does all that money go when fear spikes like this? It runs for cover. We saw a classic flight to safety, with investors dumping riskier stocks and just piling into the perceived safety of US government bonds. When you see bonds outperforming stocks, it's a super clear sign the market is playing defense, not offense. So when you combine a spiking VIX, a frantic rush into bonds, and all the other components of the index, you get this result. The needle on the Fear and Greed Index didn't just drift into the fear zone, it slammed all the way over to extreme fear. The market wasn't just nervous, it was genuinely terrified. And then, just as quickly as the panic set in, the entire narrative just flipped on its head. While US markets were closed for the weekend, something changed. The mood shifted from, abject terror to cautious optimism. This is where that whiplash really kicks in. And this was the catalyst. A simple change in tone. After a weekend of frantic speculation, headlines like this one started to pop up. The rhetoric softened, and suddenly, it seemed like a deal might actually be possible again. It just goes to show you, in a nervous market, a few carefully chosen words can be enough to reverse a total nosedive. And the effect was immediate and incredibly dramatic. This is what traders woke up to on Monday morning, a sea of green. Pre-market futures were soaring, with the NASDAQ 100 up almost 2%. It was a complete 180-degree reversal of Friday's bloodbath, all driven by that simple shift in sentiment.
So, with the immediate panic starting to fade, professional traders and investors, they shift their focus. They move from just reacting to the last headline to trying to anticipate the next big move. And a huge part of that is figuring out what the US Federal Reserve might do next. This brings us to another critical tool, the CME FedWatch tool. It essentially reads the minds of professional traders by analyzing futures prices, which are basically bets on where interest rates will be in the future. It then spits out a real-time probability of whether the market believes the Fed will cut, hold, or raise rates at its next meeting. It's fascinating stuff.
Now, a shock like a sudden trade war can dramatically change these odds. If the market suddenly gets scared of an economic slowdown, that probability of a rate cut to support the economy is going to shoot way up. Traders are constantly adjusting these bets in real time based on the very latest news and data.
So, the FedWatch tool shows us what the market expects the Fed to do down the road. But we can also get a snapshot of what traders are doing right now. Tools like the ONDA order book, for instance, show us where actual buy and sell orders are clustered for major currency pairs. Think of it this way. FedWatch is the long-range weather forecast, while the order book is like looking out the window to see if it's raining right now. Both are really valuable pieces of the puzzle.
Okay, so we've dissected the anatomy of this 48-hour fire drill. Now for the crucial part. What comes next? Markets don't operate in a vacuum, and the next wave of volatility is always just one headline or one data point away. Looking at the economic calendar for the week ahead, which we pulled from investing.com, there are several key events that could easily spark the next round of volatility. Any speech from the Fed chair, for example, is going to be picked apart for clues about future interest rate policy. And earnings from major banks like Goldman Sachs and JP Morgan, that gives us a direct health check on the financial system. Each of these is a potential market mover that traders will be watching like a hawk. And this brings us to our final and really critical question. After watching a market plunge on a single headline and then rally on just a change of tone, we have to ask, are long-term economic fundamentals still in charge? Or is market sentiment, swayed by the news of the hour, the new king? It's a huge question for any investor to think about. Thanks for watching. Don't forget to like and subscribe.